What's going on, my fellow wealth creators? Matty Ice here, and in this video I want to talk about the biggest problem with saving money in the bank. And I was inspired to do this video because I was having a really good conversation with a great friend of mine the other day, and one of the things that came up was this tour that he did of the Federal Reserve Bank downtown here in Jacksonville. I don't know if it was like, I don't think it was an actual like Federal Reserve branch. I don't think they have that in Jacksonville, but it was more like an institution for teaching the history of the Federal Reserve Bank, which I didn't even know existed. Definitely on my bucket list now. I can't wait to do that. But anyways, at the end of the tour, one of the members in his group asked the tour guide, what does the Federal Reserve do to combat inflation? Which is kind of a cheeky question. I think he knew what he was asking because they don't combat inflation. They create inflation, which is... you ask different people, you get different answers. I would call it, you hear silent tax. I think it's just straight up theft, in my opinion. But it's basically the erosion of our purchasing power, right? And they claim that that's good for the economy, and that's a whole other conversation. But the fact is, inflation is one of the biggest problems with saving money in the bank, and it actually punishes us for saving money. It forces us to become investors, essentially, right? And it got my friend thinking that this is kind of how we got into the conversation. It got him thinking about the money that him and his fiance have been able to save up over the past few years. I mean, they've done pretty well, and that's why he's starting to look at different investment opportunities and stuff. We talked about that, and but the biggest concern was like, well, we have money saved, but even though the dollar amount in the account doesn't go down, the purchasing power does. And I really want to hit this point home, guys, just how devastating inflation is. And then we're going to talk about some different things that I'm doing in my life to combat inflation right now. This is not investment advice. I'm not a financial advisor or anything, guys. I'm just sharing my journey, okay? But here's the thing. At just a 3% inflation rate, which is where I think it's actually worse than that. The Fed's target inflation rate is 2 to 3%, or 2%. I'm sorry. I don't think they're going to get back down to 2%. Right now, I think it's 2.5, maybe. But either way, the compound effect of inflation on our purchasing power is, I think, grossly underestimated and not accounted for when it comes to financial planning and personal finance. Like it's devastating, guys. At a 3% inflation rate, it doesn't sound like a lot, especially if you're making 12% per year in Dave Ramsey's mutual funds, wherever those are. That's hilarious. But here's the thing: for the average American, we're not doing 12% every single year. Okay, so we're not even close to that. But 3% means 3% inflation, because guys, inflation compounds against us. Okay, what that means is that every 26 years, the cost of living doubles. So the cost of goods and services doubles. That means if we live into at least our late 70s, okay, the cost of living is going to double 3 times in our life. That is crazy. And that needs to be a very important part of putting your wealth building plan together, in my opinion. Because, yeah, you can make money and maybe your wages are increasing a little bit. I think they lie to us about the inflation numbers. I don't think even when they say it's at 2% or 3%, whatever, I think it's way higher. I mean, all you have to do is go to the grocery store. Stuff has literally doubled in price over the last couple of years. It is absolutely insane. Everything is so much more expensive, right? And that puts a lot of strain on people, obviously. And so I think they lie to us about the inflation rate. And here's the thing: if you're following traditional financial advice, what mainstream media tells us and what society teaches us to do, and that is to dump as much money as we can into our 401ks and tax qualified plans, etc. Not saying not to do that, not saying they're bad, but is that going to be enough to create the nest egg that you need to maintain your standard of living 40 years from now, 30 years from now, 60 years from now? Just depends on how old you are and also how long you live. People are living a lot longer too, guys. You have to remember that. So if the magic number in mainstream media with tax qualified plans and stuff is to hit that elusive $1 million portfolio, right? So there's a couple of problems with that though. So number one, is that even going to be enough by the time you reach retirement? If the cost of goods and services doubles at least twice before you hit your retirement age. Okay. So realistic, like basically what that means is if you're shooting for $1 million and the cost of goods and services doubles just once, but before you hit retirement, you need $2 million just to maintain the same standard of living that you're at right now. Right? That's crazy. So is what you're doing right now going to get you to a $2 million portfolio? I don't know. Maybe it is, maybe it's not, but it's something to think about because having $1 million sounds great. That sounds like a lot of money, but in 25 or 26 years, 25 years, whatever, when cost of goods and services doubles, is that a lot of money? I don't know. Probably not, as the purchasing power continues to erode. And here's the other thing about that is, and this is one of the issues I have with like things like 401ks and tax qualified plans and stuff. You know, it's they're good for the right person, I guess, but definitely not for me. I don't see the benefit. I'd rather have control of my capital. I prefer investing in real estate as well. But here's the other thing though, is you might have $1 million, maybe you reach the $2 million mark. That's great. Okay, congratulations. So you have this big bucket of money, but how do you spend it? Have you ever asked yourself that? Have you ever put a distribution plan in place? Because a lot of the times we focus so much on accumulation, we don't have a plan to distribute that money. Because what's going to happen a lot of the times, because that money it was made with pre-tax dollars, you're going to pay taxes on that. And here's what's really bizarre is when you ask a lot of people, do you think taxes are going up, down, or will stay the same in the future? 9 times out of 10, people are saying, I think taxes are going up. Why? Well, because you look at the national debt and how much money the government is spending and all the entitlement programs that we have. How do you think that's going to be paid for? Well, taxes. Right? They're probably going to increase taxes. And if you look at taxes historically, the marginal tax rate is pretty low at the moment. Again, historically speaking. So if you think that taxes are going up in the future, then why not pay the tax now instead of later? Because you're probably going to end up paying more in taxes later. Not to mention you're being taxed on a much larger number as well. The old saying goes, would you rather pay tax on the seed or the harvest? I'd rather pay tax on the seed. I'd rather get the tax out of the way. That way I don't have to worry about it later on down the road. So you have taxes, not to mention you have to make that money last your entire retirement, right? So yeah, you might be rich on paper, but how much of that can you spend? If you have $1 million following the 4% rule, which actually I think is a little high now, I think they're recommending 3% now. That's $40,000 per year. I mean, is that really what we're shooting for, guys? You know, and I saw this article the other day talking about like by the time you hit retirement, you should be in a lower tax bracket. I'm sorry. Who wants to be in a lower tax bracket? That means you're lowering your standard of living. I thought at retirement, those were supposed to be your golden years and you're supposed to finally be able to live life to the fullest. But how do you do that if you're in a lower tax rate? That means you're making less money. You have less spendable income. That part never, ever made sense to me. I'd rather pay more taxes, be in a higher tax bracket and live the life that I want than force myself to be in a lower tax bracket. Like that just doesn't make sense to me. I'd rather just make more money and then obviously implement specific tax strategies to lower it. But anyways, I digress. So just some things to think about and just kind of bringing this back home, bringing this full circle. All right. The issue with saving money in the bank is that it doesn't do anything for us. Actually, it works against us because if we have money sitting in the bank, it's literally losing purchasing power every single year. Our wealth is going backwards in that case, which is so frustrating because saving money is a really good thing. We want to save money. When my marketing agency started doing really well, I just saved everything. I did not increase my expenses very much at all. I was just stacking cash. I was just saving it. And building your base, saving your money, if it's in the bank for a while, that's fine. Like while you formulate a plan, you figure out where you want to put your money. That's fine. But long term, saving money in the bank, I just don't think is very prudent because of inflation. And so the question becomes, okay, well, where do I save my money? And I want to be clear here, guys. I'm not saying take all your money out and you have to put all of your money into investments. I'm not saying that, guys. Again, it's not investment advice. I'm sharing my experience, my journey, and what I'm doing to solve these problems in my life. Because this is a problem for me too. Inflation impacts everybody, right? And so we have to adjust and adapt. Okay. So with inflation, I forgot where I was going with that. Inflation, saving the bank. Oh, that's right. So saving money, really, really good stuff. Okay. But long-term, keep it in the bank. Can't do that. It pays us no interest. And all we're doing is making the bank richer. I'm sorry. I want to build wealth for myself. I don't want to build wealth for the bank because they pay us, 1% less than that historically. I mean, there's high yield savings account at the moment, but how long is that going to last? Historically speaking, savings accounts just don't do anything for us. So my question became, why, if I'm going to save money, why not save it in the most efficient way possible? And the other thing I was going to say is I still, to finish up the other statement about not taking all of your money out of the bank, right? I still have money in the bank, guys. It would be foolish not to, okay? But the majority of my emergency and opportunity money, my working capital, I guess you could say, for building wealth and preparing for emergencies, I put into, you know what I'm going to say here, unless this is your first video that on my channel that you're watching, mutually owned, dividend-paying whole life insurance policies. Mutually owned life insurance companies in participating dividend-paying whole life insurance policies. All right. I've got a ton of training on my channel about that. Make sure you check it out. But, when you hear Dave Ramsey talk about whole life insurance, you probably just, you cringe when you hear that term, whole life insurance, right? He's completely wrong about whole life insurance in the sense that he's not telling the whole story. All right. He's talking about a specific type of whole life insurance. That's probably not a good place to store your money. However, when you custom design them and set them up right, they are fantastic. And my question became, if I'm going to save this money, I've accumulated this money here, but it's just sitting here not really doing anything. In fact, it's going backwards in purchasing power. If I'm going to save that money, why not save it in the most efficient way possible? And why custom designed whole life insurance policies are so effective for saving money is because of the liquidity. And there's more to it than that. But basically, like when I set my policies up, I put a large amount of money into it, just basically transferring it from the bank into my whole life policies. And I immediately, not immediately, but very quickly had access to the majority of that money. So that if an emergency came up or took place, or an opportunity came up that I wanted to take advantage of to build my wealth, I can get access to that money in the form of a policy loan very, very quickly. Now, the benefit of that is that taking the policy loan, yes, there's a little bit of interest that you pay, but it's a small price to pay for the benefits that you get because that my money is still in the policy getting uninterrupted tax-free compound growth. And these policies, when set up correctly, typically net 3 to 5% compound growth for the life of the policy. My first one is about 4%. I have to check what my other one was. I think it's like 3.5%. I got to double check. But anyways, to me, that's a really good savings vehicle. Okay, so Dave Ramsey and other influencers try to compare whole life insurance to that, the internal rate of return of whole life insurance to that of other investments, stock market, mutual funds, ETFs, whatever. That just doesn't make any sense. You're comparing apples to tater tots. Would you do that? No, they're completely different, right? So if I were to ask you, if there was a savings account at your bank that would pay you 3 to 5% tax-free compound growth for the rest of your life and allow you to use the money in the account to build wealth like you normally would without interrupting that compound growth, plus it would pay out blossom into a massive income tax-free death benefit to your loved ones if you passed away unexpectedly. Is that a savings account you'd be interested in? I think most people would say yes to that. Well, if you say yes to it, then a custom design whole life insurance policy is definitely worth considering if you're saving money. Because if my first policy is netting 4%, I'm now at least keeping up with inflation. Not to mention that doesn't take into consideration the tax advantages of these whole life policies, right? Tax deferred growth. I can get tax-free access through policy loans. I can withdraw up to my basis or my principal. Right. So tax advantages, we have living benefits as well. If I get diagnosed with a chronic, critical, terminal illness, I can access a large portion of that death benefit to get the care that I want, right? That maybe health insurance wouldn't cover. We have the death benefit. It solves so many problems, and yet I still have access to build wealth. I have access to that money to build wealth without interrupting the compound growth. So now I'm really accelerating the wealth building process. Now I'm really outpacing inflation. When I invest in real estate, for example, I just did my first private money deal. I made a loan on a real estate project at 12% plus points. I think that's well above inflation, and I didn't have to risk it in the stock market either. It's backed by a hard asset. First lien position is backed by a hard asset, working with a very, very experienced investor. That's pretty good. I think that's pretty good. All the while, my money's compounding in the policy, right? So again, thinking about if you're saving money, why not save it in the best way possible, in the best vehicle possible? And maybe this is not for you. Maybe, whole life insurance and infinite banking and all that stuff, definitely not for everybody. I get it. But it's just something to think about. If you have money sitting there in the bank, not doing anything, well, it actually is doing something. It's going backwards, guys. And these are the things that we have to do. This is the reality that we live in. Unfortunately, we are punished for being good with our money and saving it. It forces us to become investors. Not necessarily a bad thing with that, but it just is what it is. A lot of people I know would rather just save money and maybe get a decent return and just not have to worry about inflation eroding our purchasing power. But it is what it is. So I just think that when you put your money, I know this for me, my experience with this, when I put my money, my emergency and opportunity money into these policies, I still have some money in the bank for, quick, unexpected expenses and regular monthly expenses, right? But the majority of my emergency and opportunity money is in these policies because I want to outpace, I want to keep up with inflation, I want to beat inflation, and obviously we want our quality of life to increase. We want to provide for our families, etc. We want to live a good life, and you have to put your money to work to do that. So, saving money in the bank, just not very prudent. And again, also when I set my policies up, it gives you a peace of mind also that while you're researching different investments, like how to deploy your capital, at least that you're keeping up with inflation with these policies, and you have all these other benefits as well. And it just gives you a lot more power, I think, and with when it comes to researching different investment opportunities, how to build wealth, how to outpace inflation, et cetera, as opposed to just following what mainstream media tells everybody to do. Just max out your 401k, buy term and invest the difference. Maybe that's right for some people. I think if a lot of those people understood that there are other options, they'd probably go with those other options. But either way, just something to think about. I hope this was helpful, guys. If you have any questions, comments, I'd love to hear your feedback as well. Drop them down in the comment section below, and I will talk to you in the next one. To your success. Matty Ice is out.